earnings update of Can Fin Homes Limited, hosted by Investec India. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitish Jain from Investec India. Thank you, and over to you, sir.
Thank you, Avirat. Good afternoon, everyone. Welcome to the Q1FY26 earnings conference call of Can Fin Homes Limited. To discuss the financial performance of Can Fin Homes and to address your queries, we have with us Mr. Suresh Iyer, MD and CEO, Mr. Vikram Saha, Deputy MD, Mr. Prakash, General Manager, and Mr. Abhishek Mishra, CFO of Can Fin Homes Limited. I would now like to hand over the call to Mr. Suresh Iyer for his opening comments. Over to you, sir.
Thank you, Nitish, and welcome to everyone to this earnings call for the first quarter results of Can Fin Homes. As just informed, we just want to first of all introduce that we have our new CFO, Mr. Abhishek Mishra, who has joined, and he's also present in this call today. He's just joined on 30th of June, and as you would recollect that in the month of December, we had put up the notice regarding the resignation of our previous CFO, and thereafter his last day was on 20th of March. So now we have the new CFO, Mr. Abhishek Mishra, joining. Now to the certain points about the business. For the first time, a few positive points or a few positive things about this quarter. First is that in terms of the disbursement, this is the first time in the Can Fin's history that we have in the first quarter crossed the figure of 2,000 crore disbursement. So it's a 9% growth in terms of disbursement. To break it down further into the zone-wise performance, we have the zones of North, West, and Tamil Nadu, which continue to carry on the momentum from where they left off last year, and they are continuing to be in the positive. North zone is upwards of 40% positive in Q1 compared to Q1 last year. 35% plus is for Tamil Nadu, and West zone continues to at 15%. Additionally, we have the East zone, which was flat last year, which has also this quarter got into the positive mode, and it's doing at about more than 40% growth in terms of the disbursement. In terms of the two other major zones and key areas where we have business, that is Karnataka and Telangana. Telangana for us has not shown any major turnaround or anything in terms of business and continues to have a negative growth. Karnataka, on the other side, is almost flattish. We are still doing about 200 crores of disbursement, mainly because the e-Khata issues pertaining to the panchayat areas and development authority areas continue. However, on the positive side, the state government had announced that they would be taking some decisions and would be trying to resolve this issue in July. And just a few days back, there was first an announcement that the state will be allowing the B Khata properties to be converted to A Khata. So that is one development. The second development is that yesterday itself, just yesterday for that matter, the state government has released a full-page advertisement wherein they have indicated that customers can get the e-Khata for their properties from the Seva Kendras by paying 45 rupees, and they've also come out with a self-help app or a tool which people can download, which will help them on online registration of e-Khata that can be done. So the state government has trying to promote and trying to streamline the issues. So hopefully in this quarter we should definitely see a positive. In terms of the business in Karnataka, we have had good inquiries, but we are not able to log in because we are facing issues of e-Khata. Incidentally, in terms of recovery also, we have had almost close to 1.5 crore plus of properties where we have done the surface sale in Karnataka, but we are not able to execute the sale certificate only because of the e-Khata issue. So it's that also is there. Otherwise, additional 1.5 crore of collections would have come. Second positive in terms of the collection is that the total delinquency, that is SMA 0 plus SMA 1 plus SMA 2 and NPA put together, for the two positives here. One is that for the first time in the Q1 results, the delinquency, which normally always goes up, has actually come down from the March number. In fact, last year in Q1 there was an increase in the total delinquency by about 360 crores, from March 24 number, whereas in this quarter, compared to March 25 number, the total delinquency has come down by 280 crores. The second positive in terms of the collections is that this is the lowest delinquency percentage in the last 5 quarters that the company has registered. So these are in terms of this. However, while the total delinquency has come down, there is an increase in the total NPA, which is actually a sequential thing because every year in the first quarter there is a spike in the total NPA. Last year, in Q1 last year, there was an increase by about 39 crores. The year before that by about 32 crores. In this year, it is about 45 crores. However, in fact, additional point this quarter is that we have, as part of our analysis of recovery, we have identified 96 specific accounts which are very, very sticky and totaling to about 13.90 crore, which we have allowed to flow to NPA so that we can recover during the remaining 9 months through our SARFAESI actions. So this is in terms of our disbursement and collections aspects. For coming back to the disbursement portion, we have last 2 years opened 29 branches. This year we are planning to open 15 branches, for which all the 15 branches efforts have already been initiated so that in the first half, that is by September 30 itself, we can open all these 15 branches. The other point in terms of disbursement or this thing is the sales, which we had started last year with about 39 odd people. During the year, that is effective 1st of July, we have added or increased the strength of the sales team and taken it to 100 people by adding another 63 people. So therefore, that is the major thing. So the additional branches which will be added during the coming quarters, as well as the increase in the sales staff is what we expect to help in pushing business in the coming quarters. Already in this quarter, compared to last year where the sales team was contributing to about 4% of the total business, incremental business, in this quarter the percentage has increased to 5%. So the same team of 39 people has been able to contribute a little higher in terms of the business. Now to other areas of the key aspect, of course, is the cost of borrowing, because we've had 3 back-to-back reductions in the repo rate. So we have already had a reduction in the repo rate, which is visible in our cost of borrowing. However, the actual going forward rate of cost of borrowing is further lower because what has been experienced is what we have experienced for part of the quarter. Going forward, therefore, the incremental cost of borrowing which was around 7.55 is closer to 7.3. Therefore, we have already announced the further 15 basis points cut in our rate for existing and new housing customers. So we had already passed on 10 bips in the month of May. Additionally, from July, we have passed on additional 15 basis points to our existing and new housing customers. So totally taking it up to about 25 basis points of rate cut for our customers. Additionally, going forward, we still have about 2,500 to 3,000 crore worth of bank term loans where we expect a further reduction because we are yet to receive that 50 basis points cut of the repo rate of June in those 2,500 plus crore of bank borrowings. Plus, NHB also has indicated to us that the regulator will also be reviewing its PLR because it has not done so far in the last 6 to 8 months. So we are expecting a rate cut coming from NHB also. So going forward also there will be some impact. Of course, as and when we experience post that, we will be passing on our rate cut to our customers. In terms of the asset side, we have about, because one key aspect is, if you would recollect, we had in January 2024 moved from an annual reset to a quarterly reset. So all new customers who are onboarded from 1st of January 2024 are on quarterly reset, and we also offer the option to customers to shift from annual to quarterly reset. As of 31st of March, we had about 72% of the customers who were still on annual reset. By the end of this quarter, that is on 30th June, we have about 67%. So only 5% of the customers, including the new customers, have actually moved from annual to quarterly. So as on 30th of June, we still have about 67% or 2/3 of our portfolio which still continues to be at annual reset. So we are sending customers intimation about this shift. So as and when they come, they will be able to do it. However, those who remain on annual reset will continue to get the benefit as and when their reset dates are approaching. So there could be some this 15 and 10 bits also that we have passed on. There could be some lag in the way it is passed on to our customers. Now coming to the cost to income ratio, the other two major aspects during in the financial performance is the cost to income ratio. There are basically two reasons why, compared to this, the cost to income ratio is slightly elevated. One is because we opted for a salary revision for our staff to align with the market salary packages. So that is one thing which we came at a very fag end of the quarter, but we have given the impact from 1st of April. That is one of the reasons. And because of this one-time change, there is an impact of about 4.5 crores in the actuarial valuation also, actuarial calculation also that has come here. Going forward, since no further increase is obviously there, this actuarial valuation will slightly even out, may not be as much in the coming quarter. So therefore, this cost to income ratio on that aspect will get evened out. So as compared to the first quarter results, there is also a 16.5% increase in the staff count, because of which some of the increase is there. However, if you compare the salary cost compared to our March numbers or the Q4 numbers of last year, the increase is not as much. It is mainly because of the salary hike that is there. The second aspect on cost where the increase is witnessed is the rent and taxes, mainly because of the 25 branches we opened last year, the 6 zonal offices, because last year you would recollect we had added an extra layer to improve the monitoring and oversight of the branches, which was the zonal offices with adequate staff. So 6 zonal offices were also opened after June of last year, which the entire impact is witnessed. And we have also expanded the office space in our corporate office. So mainly the reasons for rent and tax increase is because of this. Going forward in terms of credit cost, the guidance of 15 basis points will continue. We have had a credit cost or the ECL calculation for this quarter, but the way we are looking at the reduction in our overall delinquency going forward, we feel that there would be a further reduction expected in the overall delinquency even in the second quarter. Therefore, credit cost impact will not be as much. Going forward, our guidance for credit cost ratio continues at 15 basis points. Last year, excluding the management overlay, it was 13 basis points only. So we continue to give a guidance of 15 basis points, whereas actually it could be lower than that. Disbursement-wise in Q2, with Karnataka showing some improvement and other zones also doing there, we expect that internally we are pushing for 2,600 crore plus disbursement in Q2. However, as a guidance, we would say it would be around 2,500 crore plus in terms of Q2 disbursement. NIM and spread, the guidance continues at 3.5% for NIM and 2.5% for spread. And ROA, ROE also of 2.2 and 17%. And so overall, in terms of the overall disbursement, we are quite confident about the 10,500 crore disbursement figure for FY26 that we have been guiding. And we feel in the second quarter onwards, the disbursement will further pick up. So in short, that's the summary of all the aspects. I hope I have covered everything. I now throw it open for any queries. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Param Bora from Trinetra Asset Managers. Please go ahead.
Good afternoon, sir. One thing I wanted to ask was, what is the progress on the planned, you described the progress on the planned 50 new branch openings. So what are the geographical focus on this expansion, and what is the target number of branches by financial year 28?
Okay. For this current year, we are looking at additional 15 branches. We have 234 branches as of 31st March, and we are looking at 15 branches, majorly in the west and north geographies, and that will take our strength to 249 by end of FY26. And for FY28, we have a number of 300 branches that we have targeting.
Okay, sir. And one more thing what I wanted to ask was, are you planning to enter any entirely new state or union territory, or will the expansion focus will be on the geographies which you already have presence in?
See, we are already present in 21 states. So by and large, we have at least, a small presence or a larger presence depending on the state. We are already there. So we are not planning to open in any new geography or any new state. But existing states, we will definitely be expanding only there.
Okay, sir. Understood. Thank you.
Thank you.
Thank you. The next question is from the line of Siddhant from Goodwill Capital. Please go ahead.
Hello.
Hello. Yeah, go ahead.
Yeah, hi. Yeah, I wanted to know about the competition we are facing from PSU banks. Has it intensified or is it at similar levels? And are our customers asking for EBLR?
Siddharth, so basically from PSU banks, we are having, obviously they have reduced the rates and passed on the entire 1% repo rate cut to all the customers. However, most of the PSU banks, if you see, are in the higher ticket size segment, at least the active ones like SBI and Bank of Baroda and all. So we are not facing so much in case of our segment, which is mainly below 25 lakhs. Our average ticket size is 24 lakhs for housing and 14 lakhs for non-housing. So we are not so far facing. And anyway, what is happening is the rate cut also has put a lot of pressure on their margins. So the aggression which is otherwise there is not coming more. In fact, it is the inquiries are coming more from the customers, not from the banks actually pushing it on the ground. So that is there. Second, as regards the customers asking for EBLR, well, first of all, there is no requirement of EBLR. So customers are asking for a rate cut. So they are not much aware about EBLR or this or that. They are generally looking at repo rate and saying you also pass on some benefit to us. And as mentioned, we have passed on 25 bits to our customer. Just to give you an idea, today I believe there is only LIC, Housing Finance and us who have actually passed on some rate benefit to our existing and new customers. And LIC also, if my knowledge goes right, is about 25 basis points, the same as us. Whereas other players in the housing finance segment or NBFCs have not reduced it for existing customers, nor the private sector banks for existing customers.
Okay. When do you think we'll be able to pass on?
So as I said, we have already passed on 25 basis points to our customers. 25 we've already done, 10 basis points effective May, and additional 15 points effective July. But as I explained in my initial message, that this will pass on to the customers as per their quarterly or annual reset plan, and also as per on the month on which they have taken the disbursement.
Okay. What would be our average CIBIL score for our customers, just to get an idea?
Today, actually, about 80% plus of our customers are having a CIBIL score of 700 plus, and about 9% of our customers are having are new to credit.
Okay, that's great. Which quarter are we going to have our tech update? Hit? Is it in Q2 as planned? Q3?
Sorry, I didn't get you.
The tech upgrade.
Yes, so see, the tech upgrade is planned in two phases. The first one will be in September, August and September, where we'll be moving the borrowings and ALM and that plan, because that is something which is not currently linked to our normal LOS LMS. So we'll be moving our ALM borrowings and that plan treasury module in the month of August and September. But the core, which is the LOS, LMS, the DMS and the deposits, will move in the month of November, which is in the Q3.
Okay, just the last question is, our dividend policy, is it going to be around 10%? This year.
I think last year our average dividend payout was around 18% or something. So I guess 20% is something we would be in the range of about 18-20% is what we would be maintaining.
Continuing. Okay, perfect.
Thank you. The next question is from the line of Shweta Dabdadar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So, a couple of questions. So, for Telangana in particular, we had mentioned that positive cues are emerging, and now we are seeing no major turnaround. So, what has changed between Q4 and Q1? That's question number one. Second is, so our DSA dependence reduction strategy have not yet met up a reasonable success, right? So how is the sort of way forward there? And lastly, while you did mention that sizable amount of transmission on the yields front have already happened, and maybe around 15 bips or 10 to 15 bips is around the corner. So any scope of further improvement of margins, say beyond 3.5%? So yeah, those are the three questions.
Sure. See, in Telangana, as I was saying, this quarter we have not seen much of a change. However, the overall reduction in delinquency that we had seen has been witnessed across the board in all the 6 zones. It is not that, some zone. So that is one thing where the pressure of so delinquency is one positive. And second thing is that in Telangana, we have also made some, changes in the teams and also in terms of the, micro focus and micro analysis also we have done. So I think we should now start seeing something going forward in terms of disbursement. We have already started witnessing and the thing in terms of our delinquencies. As regards the main reason why Telangana was not doing well was the Hydra project. And of late, the demolitions, as I had mentioned in the last quarter also, somewhere, in the Q4 somewhere, the government came out with an announcement that they will not make any further demolition. So at least I believe for the last 6 months or something, there have been no demolitions under this Hydra. And so that slowly the confidence is also building up in the developer segment and in the people also. Therefore, this is one thing which is slowly now kind of changing things. Because once demolitions happen or all those things, in fact it also affects the price. Now that there is no risk of demolition and all, slowly the prices also are kind of stabilizing, and therefore the customer confidence is also improving. So basically that is what has changed in Telangana. Second, as regards the DSA dependence, it has marginally further come down. We were at 85% in if I were to say in Q4 of FY23. Okay, from there it has consistently reduced to 82%, last year to 80%. In this quarter it has reduced to 79%. And as I mentioned earlier, two things. One, this additional sales staff that we are doing, that is something which is going to bring in more direct business and will slowly help in reducing the DSA focus. And second, in fact, which I missed to mention is that we have had last year 80 ACS proposals. And this year also we've added additional APF proposals. So now initially it was more of enrolling the APF proposals or just getting ourselves enrolled as a approved lender. But now with regular contact and everything, we have started getting good inquiries from the APF projects also, directly from the builders or from the sales teams of the project sites. So basically these are the two reasons why this would slowly emerge. But as long as the DSAs are there, it is not that we want to reduce the amount of dependence or we want to reduce the DSA number or we want to stop doing DSA business, but it is just that our direct business, as it increases, the percentage of DSA business will slowly come down. And the last part as regards margins, I guess we are already at 3.64, which is above our guidance that we have been consistently giving of 3.5. So we have maintained that we will be about 3.5, and in this quarter also from 3.57 it has increased to 3.64. So I guess that will continue, that we will continue to keep it about 3.5. Now 4% and all, I am not sure it is possible any time now. I think it is. We also have to be cognizant that we have to offer attractive rates to get a better quality customer. So that is one thing. So that's about it.
Thank you, sir. Very useful.
Thanks, Sweta.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, Suresh. After 4 questions. So given the fact that we are facing the issues in growth, are we thinking of
having any co-lending arrangements with other HFCs or banks? First. Second is, I see a housing CRE segmentation around 11% of our AUM. So is that the construction finance or is it the ATF sales? Related to this, do we have any plans to have a construction finance vertical, LRD vertical to support the growth? Given the fact that we are optimistic about the second quarter and second half in general, what is the number of home loan contracts we would onboard on a monthly basis? What are we budgeting for? And most of the HFCs have a separate subsidiary for cost measures to onboard the sales staff. Like I'm sure you'd be aware of it. For example, HDFC sales was there. So do we have plans to have a similar subsidiary? Thanks.
Yeah, good afternoon, Subhranshu. Thank you. I'll just respond one by one. See, as regards co-lending and everything, we have not, definitely not with the banks, because today we don't have any pressure of, so we will actually have to be the majority or the primary lender. So the 80% has to come to us if it is there. So obviously we cannot, have a co-lending arrangements with banks because they would want to be the major partner. Here we will have to, if at all, do it with the smaller players where we can get 80% of the portfolio or the pool, and the origination happens at the other end. Now, as of now, we don't have any policy for DA or for portfolio buying or co-lending. So we are actually open to it, but we will take it as we once this post this IT implementation or something, we will take it, because right now one after the other we are handling other issues. So we will be taking it up probably after that. As for CF, currently we don't have a CF business, and we don't intend to also start direct lending to developers. We will be more purely into the retail segment only as of the moment. Now the next question, as regards number of contracts, we are doing approximately about 4,000 to 4,200 contracts a month, which is approximately around 48,000 to 50,000 in a year is what we are doing. In fact, this number has been a little kind of very steady for the last few years, and the growth, whatever has come, has mainly come from the ticket size increase, because we were about 20 lakhs and moved to 22 lakhs and now at around 24, 25 lakhs. So basically, the number of contracts per month have remained the same, which is something we know with direct sourcing we expect to increase. Third, as regards sales staff, there are 2 points. One, definitely not a subsidiary. We already are, have a lot of reporting at the top as part of the conglomerate and Canara Bank group entity. But we don't intend to have any other subsidiary under us. That is one. But as regards the sales staff, I think you also mentioned there is a cost angle to the sales staff. So you are right in one sense. But, there is one option where most players are going for a DST route or DME route, whatever, where, the fixed cost is just about 15,000 to 18,000 rupees and the remaining is entirely on a variable pay. But, that we explored rather than, we said it is still okay from the cost point to take people on road rather than take it on this kind of a model. Because when people are taken on this 15,000, 18,000 thing, the attrition rate is very, very high. In fact, the minimum rate that we understand prevailing in the market for these kind of arrangements is about 60 to 65%. That is the minimum attrition rate. There are players who are even experiencing 100% attrition in this kind of a model. So we chose to have a model where we will have them on the roll, and they will be coming with whatever lowest, even if they come at the lowest entry level, it will be around 38,000 fixed salary. That's the kind of structure we are opting for. So I hope I've answered your queries.
Just one part, Suresh. This housing CRE, this is what, ATF sales? What is this then?
Sorry, I didn't understand. Can you come?
So on slide number 19, we've got housing CRE. These are the ATF sales, is it?
No. CRE, that is different. See, if it is a third house of a person buying a third housing and they are already having 2 residential units, then the third will not enjoy the same kind of a risk weightage as the first 2. So those will be classified as a CRE, the third and subsequently. Same way, like in Karnataka, there is a particular trend that people may put a house with 2 floors and they give the first and second floor on rent, and there are 3 kitchens. So those also technically are qualified as CRE because there is also a part element of income generation from these assets. So this is basically CRE is housing only, it is a dwelling unit only, but they classify for a different risk category, risk weightage. So that's the CRE. The housing, as I mentioned, we don't have a developer finance, and whatever we get from the APS projects, they are normal housing. If it is a third house of a person, it will be classified as a CRE.
Okay, so what is the risk weight on these?
The risk weightage is higher. I'll share the exact risk weightage for CRE separately. I am immediately not.
Sure. Thank you so much. Best of luck for answering this.
Thank you.
Thank you. The next question is from the line of Anusha Raheja from Dalal & Broacha. Please go ahead.
Yeah, am I audible?
Yeah, you're audible. Please go ahead.
Yeah. So on the spread side, sorry if I'm being repetitive, you said that till the time it gets affected with the customers who are on a annual reset, and that share is closer to around 72% odd. So can we expect in the near term margins of the spreads to improve?
Currently it is 67%, 72% was in March. So I said only 5% have moved. But yeah, actually what we have seen a slight improvement in margin is mainly because of the delay or the lag effect of the PLR benefit is going to the customers, because after we experienced, when we experienced 10 basis points we took out after the February rate cut, when we experienced it by 31st of March, we had in the April ALCO, we witnessed the 10 basis points which we passed on effective May. Obviously now we have already experienced it in our liability side, and then when it goes to the customers, it will pass in maybe next month or 2 months later or 6 months later or 8 months, depending on the thing. So that is where this increase in spread has slightly happened. So going forward also this 15 basis points plus any subsequent rate cut that we offer will also go with a slight lag effect. So maybe it can be possible that a little bit of increase in spread might be there going forward also. But I'll not be able to quantify it, but I guess it is possible. Yeah, you're right.
Mm-hmm. And secondly, what is the incremental cost of borrowing currently? And assume that if there is any further reduction expected over the next 6 months' time, and so will that also be passed on to the customers?
See, incremental cost, of course, different products have a different. So it depends on which segment we would want to go to. Like for example, we are getting bank borrowings at around 7.25, anywhere between 7 to 7.25. NCD rates are also at the same rate. CPs are below 6 for us actually. In fact, today only we've raised at around 5.92. That is a 90-day CP. NHB, as I said, going forward, where the reduction is expected is that we have certain term loans where that 50 basis point reduction which happened in June is yet to be passed on. So that amount is around 2,500 to 3,000 crores between that. That term loans will experience a reduction in the coming couple of weeks. Another thing is NHB, which is about 15 to 17% of our entire borrowing pool. There no reduction has happened. The regulator has not announced any reduction in the PLR. So as and when that is announced, we will also start getting that benefit. So there is some further reduction possible in our borrowing cost. As I mentioned today, the mix is such that today we are right now taking mainly from the banks and also a little bit of the, but NCDs we will mostly take after August, because we have also extinguished our approval limit that our shareholders have given for the last year, about 4,000 crores. So when we get the new limit, we'll again go for NCDs, which again could be a little lower than banks also possibly.
And what would be the quantum of benefit that we might get in terms of on the term loans in NHB? You said that there can be rate benefits. So both put together, can you quantify on this?
See, our total NHB borrowing is already given in our presentation. So on that, we don't know how much is the rate cut that NHB will announce, and what are the terms, whether that will be immediate, whether that will be on a quarterly basis, or whether they will immediately impact it, because already it's been more than 6 months that the rate cuts have started, but they have not done anything. So it is quite. So I will not be able to quantify as of the moment. It all depends on how much NHB passes on, and on what terms it passes on to us. But I would say if at all it comes, today 50% of the NHB, or I think about 45% of the NHB borrowings are on fixed rate, because these are under the special AHF line of funding where the rate is fixed. So even if at all we get, it will be again on the balance about 3,500 crores kind of thing that we will get. Currently our NHB refinance is 5,800 crores. About 40% of this, as I said, is fixed, the AHF. So the remaining 60%, which is around 3,200 crores or something, is where we will get the rate benefit when NHB passes.
No, so my thought process, your thought process here is that you will continue to have a 3.5% margins. So irrespective, if you get a higher benefit, that will be passed on to the customers. Is that the thought process?
Yes. We have been very transparent in that sense that whenever we experience a benefit, we do pass on to our customers. And of course, when it increases also, we are passing on to it. So that is the...
And so, and on the IT transformation, what is the status currently? Where are we?
In the IT transformation project, as I mentioned, there are two phases in which we are going to be implementing. So on both the things, we have our governance structure where we have a daily stand-up meeting, we have a weekly and fortnightly meetings and all, and once in 45 days meeting for update to our IT strategy committee. As of now, the project schedules are going as per the timelines which were given or drawn up at the beginning. So we are very much on course for August end implementation of our ALM and treasury modules and borrowing module, and November first week for our LOS, LMS, DMS and everything.
And if I'm not mistaken, the quantum is around 35 odd crores projected per year, right? Hello?
Hello, sir. Am I audible? Looks like we have the management's line disconnected. Please stay connected while we reconnect the management. We have the management's line reconnected. Ms. Anusha, please go ahead with
We had a small issue here. I guess I was just mentioning that, Subhranshu, to your last question, the CRE risk weightage is 100%. Hello?
Anusha, please go ahead with your question.
Yeah, just one last question from my end. Sir, can we expect the assets growth, to pick up the pace? We can push the pedal there more when the IT transformation is done? I hope I was audible.
Sir? Please stay connected. We have the management line disconnected.
Hello?
Yes, sir. Please go ahead.
Yeah, AUM growth, I think you were asking for. So yes, going forward, definitely with the increase in our growth, disbursement growth, the AUM growth should also pick up. Normally it comes with a lag. So this year, if we are doing about 10,500 crore, at the current rate, we should be able to add about 5,000 crore to the AUM, which should be around 12 to 13% approximately growth in the AUM. And with the same kind of growth in the coming year, in terms of disbursement, the next year growth should actually increase or move up to around 15%.
Okay, sir. Thanks.
Thank you. The next question is from the line of Pavan Kumar from Ratnatraya Capital. Please go ahead.
One thing I wanted to check was non-employee expenses. There has been almost like a 10 crore decrease. I just wanted to understand what is it and is that sustainable? And secondly, what are the kind of growth drivers we are looking at going forward? What will change for us to actually achieve this particular growth? Because
So as I mentioned, I think other than the salary cost, the major area where the cost has gone up is mainly the rent and taxes, because last year whatever we added the 25 branches as well as the 6 zonal offices and extra that space that we have taken or increase in our head office, all that has come post June. So in the first quarter, all these expenses were not there. So that is actually quite a large component. The second component is about 1 crore additional in distinct provision we have made for our CSR expenses, because with the increase last year we had a CSR target or budget of 16.12 crores. This year it is 19 crores plus. So therefore about 75 lakhs is the extra CSR apportioning that has happened in this quarter. So these are the two major expense on the expense side. As regards growth drivers, one of course is the branch expansion that we are doing. The last, in fact, 29 branches that we have opened net in the last 2 years. In fact, they have also started contributing. Last year, the total additional business that these 29 branches brought were about 101 crores, mainly from the 14 branches that we opened in FY25, because FY24, because FY25 branches were mostly opened in the last quarter, therefore have not contributed much last year. So this year again, all these 29 branches will be there. Plus this year we are front-ending the branch expansion, and by 30th September itself, we plan to open make all the additional 15 branches operational. So branch expansion is one area which will bring. The second growth driver, of course, is the sales team. Last year we got about 39 odd people in a sales team, and they were able to contribute in Q4 about 4% of the incremental business. this quarter, the same team has done about 5% of the incremental business, and effective 1st of July, we have increased the strength from 37, 2 people left. So 37 plus we have added 63 people. So as of now, we have 63 plus 37, that is 100, and we plan to add a few more in the coming weeks. So these are the two major drivers for growth. Of course, there will be a little bit of increase in the ticket size. And actually, Karnataka and Telangana both are zones where actually our ticket sizes are a little higher than our overall company average. And these two markets are presently also slightly weak for us. So as and when they pick up also, the ticket size over there will also pick up. So basically, it is the branch expansion and our sales team.
Can you also just give me an idea of what do you expect the cost to income be this year and next year?
This year we expect, as I mentioned, there is an actuarial impact which has come entirely in the Q1. In the next 3 quarters, actuarial impact may be a little more subdued. Therefore, by end of the year, I guess our cost income ratio should stabilize around 18%.
Okay. And next year,
next year with the IT cost coming in, I think it will be around closer to 19, because earlier we had expected it to be 17 and 18, but with the salary hike which is almost impacted by 1%, we revised our targets to 18% for current year and 19% for next year.
Okay. Thank you.
Thank you. The next question is from the line of Siraj Khan from Accidency Capital. Please go ahead.
Hello, I'm audible?
Yes, you're audible. Please go ahead.
Yeah, thank you very much. A couple of clarifications before I ask my questions. The FY28 target for branches was 300 branches. Was that right?
Yeah, that is correct. 300 by FY28.
Okay. And the ATS that you mentioned to responding to the previous question, for HL it is 24 lakhs and NHL it is 14 lakhs. Was that correct?
Yeah, average ticket size is 24 for HL and 14 for non-HL.
Okay, thank you. So now coming to the questions, firstly, I'm just seeing that there is a trend of increasing share in the more than 30 lakhs ticket size in our AUM, and that is coming at the cost of the 20 lakhs and lower taking a backseat. So the question here is, are we seeing a higher demand or a better demand in the upper bracket and or more competition in the lower bracket and therefore it not being that attractive? How is that dynamic in these ticket size brackets?
Actually in the less than 20 lakh or rather less than 15 lakh, which was mainly a large chunk for us earlier, there definitely, the supply issues are there, and I've been saying that affordable housing is slightly, going down. And now, in fact, it is also reflected in all the numbers. So that is definitely there. But yes, this 20 to 30 lakh this segment is something which, this quarter we have gone down, is something which is a worry for us. We will work on it this quarter. Definitely we will be working on that, because that is definitely not the intention. Our average, our core constituency is definitely 20 or 15 lakhs to 50 lakhs. So definitely this 20 to 30 lakh segment which has gone slightly, been affected, that we will correct going forward.
Understood. Because I think that is where you get the better yields. So that question is coming from that.
Yeah, but coming to your question, it is not because of any demand issue or something. I think we have this APF and all this focus has slightly shifted the focus. I think we would like to also focus on this 20 to 30. We will definitely see the correction in the coming quarters.
Understood. And what is the average LTV of the portfolio as a whole, just as a statistic?
Average rating?
LTV, loan to value.
LTV, ours is roughly, if you look at the, we give up to 80% of the cost, but we also have this thing of taking a valuation at the time of the loan. And obviously the realizable value and market values are higher. So if you look at the realizable value, I would be somewhere closer to 60%.
Understood. Now coming to the login growth. So our approvals have been kind of 4.6% growth YOY to 2060, and the disbursement ratio, approvals to the disbursement ratio is 98%. So it's at one of the highest levels. Wanted to know with respect to the logins, what is the login number and how is that improving? Are we seeing better traction in the logins?
Firstly, one thing I would like to share that, in the logins, we have a 30-day validity for the sanctions. So automatically the sanctions which are done get, if they are not disbursed in the 30 days period, then the sanctions lapse. That is one thing. And second thing is particularly now in the recent couple of quarters, because of this Karnataka issue, our logins slightly in Karnataka, we have not been logging in because unless we get the e-khata, because otherwise it is unnecessarily taking the processing fee from the customer, but we have not been logging it. So these are the two issues I would say. But otherwise, generally because our 80% business comes from a DSA, I would say the actual percentage that we have calculated will not be a correct representation, because many cases which the DSAs bring, if they are not doable, they are not logged in also, because the DSAs already know that what kind of cases are doable. Therefore, we don't get all the inquiries that are coming are actually not logged in also. So that is one small this thing which once the IT thing comes in and we come up with a CRM module, we will be changing that. So that will, I think, give a better and more clearer picture. I would assume that in the industry, the login to sanction and sanction to disbursement, the funnel, that should be at least a 20% fallout in the login to sanction, which is not reflective in our numbers because of this DSA focus.
Understood. Sir, I was actually looking at the NHB data, so I was just wanted the statistic with respect to the IHL book. What is our individual housing loan outstanding as on 30th June, if that could be shared?
Individual housing loan?
Yes, individual housing loan book, because the NHB publishes the data points. So I was just wanting to know what is our specific number.
I'll give you the breakup. Our pure housing loan. And I will be able to give you the breakup separately, but if you look at it, excluding CRE, today it is 74% is our housing.
Okay, so of the total book, what would be the approximate percentage, the ballpark number of individual housing loans? Or a ballpark would also suffice.
No, see, in our okay, I'll give you the breakup of housing, non-housing, everything separately. But today, our first of all, we don't have any corporate books, so everything is retail.
Understood.
Within that, housing, non-housing, I will give you the separate numbers. I'll just give me.
Yeah, no worries. Thank you. And just finally, on the the book rundown. So we've been under 4% for the last 5 quarters, and annualized it comes around to 15%. What would be BT out of this? So like, what would be the annualized BT out that we are targeting, and the overall annualized rundown rate for the year?
Sure. See, annually, if you look at it, the 15% that you're talking about, or 15 to 15.5%, out of that, less than 4% is the BT out. Because we have about 3.75% is the amortization. Then we have a huge amount of part payments coming in, which is almost around 8% or thereabouts. Where people only make part payment, but the case is still live. So which is basically just to reduce their liability or reduce their EMI. They just look at it. So our actual BT out or loan closures is only about 4% out of the total.
Okay. Thank you. I'll join back in with you.
Thank you. The next question is from the line of